We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Keith Weiner. Keith is the president of the Gold Standard Institute USA, CEO of Monetary Metals, and also holds a PhD in economics. Keith, thanks for joining me again.
Thanks for having me, Tom.
So before we started recording here, we were kind of talking about the fundamental price, and that's something that you track quite closely. And maybe we could start by giving our listeners a little bit of a review of what the fundamental price is and why it's so important and why it's actually above the market rate right now.
So, we have a model, and the first thing to be said is all models are wrong. Some models are useful. So I'm going to why our model is useful. So what we're attempting to do with this model, and then all the theory is published, we have a paper on the website about all this, is to say, okay, the price of gold is set by a combination of buying and selling of physical metal and buying and selling of futures contracts that offer great leverage. You can trade futures with 10 to 1 or maybe 20 to 1 leverage. And so because of leverage, the speculators in the futures market can push the price around, at least in the short term. Mm-hmm. And if they are manic, then they will pull the price up. And if they're depressive, they can push the price down. We kind of think of, two steel posts and a rubber band tension between them. And, if they're manic, they're pulling the price up. And if they're depressive, they're pushing it down. But if they let go, then, the rubber band will snap taut again and not be, distended like that. So that's what the model is attempting to calculate, is where's kind of the neutral set point on that rubber band at any given moment, mm-hmm. which changes every day. So, we're tracking the difference between, what the leverage speculators are doing and the physical market and where that would be. And at the same time, that's also changing every day. So it's a dynamic and it's never at rest. There are times when, the fundamental price is below market. That's not what people want to hear. I think I developed quite a reputation. I made a lot of enemies during the long, dark years of, let's call it 2012 to 2018, when every time the price would blip, I'd post a picture of this and say, this is not the moonshot you're looking for. Sorry, guys. Mm-hmm. And, they called me a perma bear and worse, shill for the Fed, all of these kinds of things. In recent years, I flipped the other way and said, we're in a bull market now. This is not the dark years anymore. And with that caveat, all models are wrong. Some models are useful. It's not the absolute level. I'm going to name some price targets here. It's not the absolute level that's really the issue here, but the fact that it's above market and significantly above market is really what makes this, interesting. So in gold, we have a fundamental price as of yesterday. Obviously, today is the day off in the U.S. So happy Independence Day to, as I say, all my American friends that are either Americans by citizenship or Americans in spirit. Happy Independence Day. But as of yesterday, fundamental price in gold is about $2,700, so considerably above market. And the fundamental price in silver is about $37.50. Again, considerably above market. Are those quote unquote accurate? No, I wouldn't use the word accurate to describe a model like that. Mm-hmm. But the fact is, it's saying it's above the market price by enough that I think the tension is the price wants to go higher. And so that perfectly comports with my view that, we're back in a bull market. This is not the sell the blips market of 2012 to 2018. This is a buy the dips, market of perhaps, 2000 to 2008 or 2009 to 2011.
Mm-hmm. So Keith, remind us of how you base that fundamental price and what data you're looking at, is it trading data you're looking at? Like, what makes up that price to determine how far above the spot price that currently is?
So it's a really good question. Most people that try to predict price, I guess they're doing one of two things. They either have a straight edge and they're looking at the price trend and projecting it, or they're doing some sort of past price moves, somehow predict future price moves, technical analysis. And I don't want to get into that whole debate. That's not what this is about. What we're looking at is a spread between futures and spot, which is called basis. So conceptually, it should be pretty clear that if let's say things are humming along, and at 11:17 a.m. Eastern time, some Fed official gets on TV, maybe it's Jay Powell, maybe it's somebody else, and says something that sounds, insane. And all of a sudden, the price of gold shoots up $50, and the price of silver shoots up $1.20. You say, okay, well, what's happening there? Just purely on a mechanical level, is that silver stackers rushing out, and like they were in the parking lots of all the coin dealers, and they were rushing out to unload all the inventory at all the coin dealers in every main street across America? Or was that traders, sitting in front of a screen or two screens? One screen is watching Jay Powell, or maybe three screens. One screen is watching Jay Powell. Another screen is watching some AI, analysis of his words and who knows whatever else, and social media response, Twitter statistics and whatever. And a third screen is his trading screen. And then when he says, okay, this is suitably insane, this sounds like the money supply is about to increase or whatever, then he presses that buy button in the futures market with leverage. And if he's doing that, then his counterpart at all the other trading houses, bullion banks, etc., are all suddenly buying. If they're buying futures, then that means they're lifting the price of the futures contract, not lifting the price of spot. Now, there's an arbitrager, we call him the warehouseman, that will arbitrage that and buy spot and sell forward to keep that spread within some bounds. But if there's just basically massive buying in the futures market, you can see how it's pushing up the price of the futures contract. So futures minus spot will be a widening spread. You have a rising price and a widening spread. And then you can look at that mechanically. If you see the basis is rising, then you say, that's obviously what's happening. So now the next thing we do is we look at the interest rate, because the interest rate determines the limit of that arbitrage, right? So the arbitrage is borrow dollars, buy metal, and sell a futures contract against it. Well, you have to borrow dollars. And so the basis can be stated as an annual percentage. That's how we quote it. So if that is greater than the interest rate, then that means it's profitable, right? You can borrow it, let's say 5.5% in order to take an arbitrage that's offering 7%. A pretty simple thing. But if there are, if the basis goes down to 5% and you're paying 5.5%, then obviously you can't borrow. It doesn't make any sense to do that trade. So the basis should be around the rate of interest. And if the basis gets significantly above the rate of interest, then that indicates that it's leverage buying of futures that have driven the price. If the basis gets significantly below the rate of interest, then that indicates that it's actually, buying metal that's really pushing the price up, not buying futures. And so we have a model that's extremely sensitive to those, changes in the basis relative to the change in the interest rate. Both of those in theory could be changing every day.
Right.
So that's essentially what it is. It's a measure of tension, in the market, and versus trying to use past price moves to predict future price moves, which there's a lot of people who do that. I'm not convinced it really works.
Like you say, it's more a measure of near-term demand in the market and how that ends up affecting, as you say, pulling or tugging on the price.
Right. I was going to say, and there's a lot of theory behind that too. So if the basis is rising, what you know is that there's more and more arbitrageurs, more and more warehousemen taking that trade. which means the marginal demand for the commodity is to go into a warehouse. And now what that's saying is that, there isn't very much demand. The warehouse demand is beating out all the other demand. That is itself telling you something bearish, that when that reverses, then that source of demand will turn off, and actually the warehouse will be the marginal source of supply when the warehouse unloads and all those trades reverse. And so that's why that's not a bullish sign. And that's the sign we saw over and over and over and over again, 2012 to 2018. Mm-hmm. That's just how it played out. And now, we see the price going up without necessarily the basis rising, or even in some cases, the basis contracting. And that's a whole different, ball game from, that bear market that we had.
Mm-hmm. Keith, I always appreciate getting to speak with you because you think about these things at such a deep level, and then you come up with ways to really frame them and make them digestible for the average person. This is a complicated model that is useful, as you said, that you guys conceptualized and then can be used to understand, let's say, which direction the model is headed. Another thing that you and I have touched on before is this anti-concept of money. But I want to start, before we go there, about discussing the anti-conceptual mentality and where that came from and what it means.
So this gets pretty deep into philosophy pretty quickly. It's pretty well known. I certainly make no secret of the fact that I'm an objectivist, an adherent of the philosophy of Ayn Rand. And I think most people are very familiar with Atlas Shrugged, and she was a leading light of the liberty movement, and that we have a right to live for our own sake, not be sacrificed for some alleged greater good. But she did a lot of interesting work in concept formation and what makes a proper concept. Mm-hmm. And it turns out that you can't just cobble together any random thoughts, paste them together in some sort of mishmash and call that a concept. That a proper concept has to be defined by its essentials. Essentially, if you say the word table, there's an unlimited number of actual table instances out there that all have something in common. And if you define that correctly, then you can recognize any table anywhere and have no problem saying, okay, this one's wood, and this one's glass, and this one's metal, and this one's plastic, and this one has 3 legs, this one has a pedestal, single leg, and so on. But they all share, some common essentials. An anti-concept is something that's defined by attributes that seem superficially to be essential, but actually aren't. And so she gives an example, and I'd say the textbook example of this is the word selfish. That people would say that the businessman who makes $1 billion in profit and the thief or the mugger who will hit an old lady over the head with a pipe to steal a purse with $20 in it, that both of them are selfish, that both of them are seeking, monetary gain. But one's a destroyer and one's a producer. One's a thug and one is using his mind for the betterment of obviously himself, but everybody else in the process. Mm-hmm. They're actually opposites. And the similarity that they both seek money is the superficial but non-essential, similarity. But the actual essential thing is that the thug, of course, doesn't care about life, his own or anyone else's. And the productive, entrepreneur who creates an iconic company does care deeply about his own life and everybody around him. And so to try to define selfish as, well, somebody who seeks money or something like that is really definition by non-essentials. And what you've created is an anti-concept that allows you to gloss over the essential difference between the thug and the businessman, usually for purposes of tarring the businessman with the same brush. Usually it's the socialists that want you to think of the businessman as evil, and they want you to think of that thug who leaps out of a dark alley and hits you over the head with a pipe. And they want you to think that the businessman is motivated by the same kind of, mentality, which of course is the exact opposite. So that's, kind of where I'm coming from with this idea of anti-concepts.
Mm-hmm. With also leaving the idea that what the businessman produces is of any good to society at all, right? It's, profit is stealing kind of thing.
Right, you're right. Leaving aside that all of his customers willingly chose to enter into that transaction, they must see some value that, of course, we, the all omnipotent, central planner, can see it's actually not in their interest after all. They're just being duped. They're in his thrall. He somehow has a mind control ray to make them give all their money to him. But when the thing about anti-concepts that's really, really deadly, if I just make an assertion and say, a business makes its money by stealing, it's pretty easy for anybody to sort of examine that. It's okay, is that really true? Well, that's not really true, is it? But if I define something in a way that is tempting, it's convenient, and it glosses over something important. If you accept the definition, right, then I've got you. I'm manipulating you in a way that's kind of beneath the surface or beneath your conscious awareness. That's what makes this really pernicious.
Mm-hmm. Keith, how do we frame, let's say, what an anti-concept of money is?
So all the key terms, I shouldn't say all, many of the key terms, including money itself, have been defined as I've just illustrated as anti-concepts. And so take money itself. I gave a talk. This is for academic Austrian economists, basically professors and postdocs and people at that level. For some reason, they invited me, so it's organized by I don't want to name names. It was organized by a university, and the chair of the economics department is a very well-known Austrian economist who's written probably a few dozen books, and is one of the godfathers of the modern Austrian school, thought, the resurgence, because obviously there was a long dark period where nobody wanted to admit being an Austrian. It resurged, in recent decades. There was a speaker who went before me who said only gold is money, nothing else. And they ripped him a new one. And I'm just biting my tongue because I was going to make that same point. Unfortunately, his presentation was, for the most part, pictures of historic gold coins. The first gold coin was coined by Lydia in around 600 BC, which is, of interest historically, but it's not of interest to the field of monetary science anyway. Mm-hmm. And so anyway, they ripped him a new one. And then it was my turn to stand up and give my talk. And for some reason, maybe because I'm an American, I just felt this chip on my shoulder, and I got pretty pugnacious about it. And I kind of had a long setup, lead into the concept of it. And I've said, in every era, there's a question hanging in the air, screaming out to be answered. I said, back 500 years ago, approximately, that question was, okay, if everything orbits around the Earth, how do you explain the retrograde motion? That the planets apparently go forward and then backwards a little bit, and then forward some more, and then backwards again, and forward some more, backwards again. This has no explanation. And when you realize that everything's actually orbiting the sun, including the Earth, then the apparent retrograde motion is just an artifact because we're standing on Earth. The other planets are in different orbits at different speeds. That's why, from our vantage point, that's how it appears, but it's really just an artifact of our vantage point. So that question had to be answered. And I said, you don't owe me an answer to this question. I said, I'm just some annoying American. I'm going to get on an airplane tomorrow morning and be out of your face. But you owe yourselves an answer. And I kind of pointed my finger and said, you owe yourselves an answer with rigor. Mm-hmm. And I didn't realize until later that there was actually an economist who stood up and talked about the idea of a rigorous answer, and then referenced the debates between Menger, who was the founder of the Austrian school, and I'm not sure if I'm going to pronounce it right, Schmuller, the German historical school guy who was Menger's nemesis, and they hated each other. And Menger admonished him at one point and said, now you have to give a rigorous answer, not any of this BS that you're, of course, in 19th century German, I'm sure that was expressed quite differently. And so the question is, I said, and I had a picture of a 19th century bank teller window, and a picture of a 19th century $20 bill. I said, supposing you hold this piece of paper, right, and you walked up to that teller window and slid that across the window. So you didn't have to say any words, no words necessary. That teller would push back a gold coin of approximately 1 ounce. So this was very well understood. It was so built into the backdrop of the culture. It needed no. It's like kind of a drive-through window at McDonald's today. There's no instructions on these things. Everyone understands. Okay, this is what this is, right? I said, if the word for the piece of paper is money, what is the word for the gold coin that comes back at you? So nobody dared try to confront me or rip me a new one at the end of my talk. I had a couple of ordinary questions. I talked about other things as well. I had a few ordinary questions, and it was on to the next. But this is a really, really important point. And in my article on anti-concepts of money, I talk about the idea of a restaurant, and you check your coat, and they give you a little piece of paper that's a coat check slip or coat check receipt. And I said, suppose in common vernacular, the word for that coat check receipt was coat, but somehow that everyone just used that as a shorthand. You can't lose track of the difference between the receipt for the coat and the coat itself, because of course the receipt can't keep you warm when it's just below freezing and there's freezing rain getting on the back of your neck. The receipt is useless. You need the actual coat to do that job. And so there's a limit to how far, but imagine if everyone was using that word, and then imagine that the restaurant went out of business and they took thousands of coats with them, and now all you just have are these pieces of paper that are circulating, and everyone's calling them coats. That's kind of where we're at today with this currency that still has, at least in the US, the euro is a whole different story, but in the US and in Canada, a vestigial almost memory tie to the fact that it was once a piece of paper that promised to pay money. It wasn't the money itself. Let's not totemize it or fetishize it and imbue in it metallic monetary properties that it doesn't have. It was just a promise to pay. And it was a credit that was only as good as the obligor's word and capacity to make good on it, which of course they all defaulted on. And if you have an old piece of paper that still says redeemable in lawful money or redeemable in gold coin or whatever language may have been on it, a century ago or a century and a half ago, those things are not. I mean, they're museum pieces in that it's a rare artifact of history, but there's nobody who's going to give you that gold coin anymore. So I call it an anti-concept to define the gold coin or the piece of paper and give them both the same word money, when in fact they actually have quite opposite characteristics, that you're defining it by non-essentials, that both of them can be passed in trade in exchange for consumer goods. That's true. That's the superficial similarity, but the essential difference is one is the promise to pay the other. And you can never, ever, ever confuse a promise with the thing being promised. Those are not to be mixed up, in my view.
Absolutely. I tried to be very careful and diligent about making sure we maintain that separate naming of the concepts of currency and the concepts of money, right? Money, the biggest difference is that store of value versus currency not having that quality over time.
Well, so store of value is another one of the anti-concepts of money that I talk about. But one of them is the metal itself, and one's the promise, which could be dishonored. Of course, today, a dollar bill is a promise to pay, and right on it is very clear that it will never be honored. So it's an irredeemable promise, which is itself a contradiction in terms. And so, we have a dishonest monetary system, one that's designed to screw, we the people.
So in that vein, Keith, I pulled a sentence out of one of your last papers here. It says, the world faces an unprecedented crisis. We have twin long-term trends, exponentially rising debt at all levels and falling interest rates, punctuated with corrections as now. These trends cause consumption of capital. So I wanted to get your thoughts on how capital is consumed in this system.
They have a variety of means. Let me start out with a really obvious one. So not in the U.S., but in Germany, in the Netherlands, in Scandinavia, in the UK, and Japan, they had negative interest rates.
Mhm.
Now, in the normal world, any enterprise that destroys investor capital should be out of business. The sooner the better, so that whatever capital has left and whatever other productive people and so on can be reallocated to somebody else who's creating wealth and not destroying it. But suppose the interest rate is minus 2%. And suppose you're only, use the word only now in scare quotes, you're only destroying capital at minus 1%. You actually have a net profit. So it's actually feeding you investor capital to give you the illusion, which of course will be temporary, it will come to tears in the end, the illusion of being profitable. So they've monkeyed with the very signal that determines what is profit and what is loss, and tampered with it. So it's worse than putting a penny in the fuse box. Now it's actively going out of your way to try to deceive people and incentivize them to, commit self-harm. So now we didn't have negative interest rates in the United States, but what we had was falling interest rates, falling effective interest rates, and that means rising asset prices. Because asset prices are basically, yes, with leads and lags and jitter and noise in the signal, but asset prices are the inverse of interest rates. It should be pretty easy to show that the bond price is the strict mathematical inverse of the interest rates, a seesaw, and then all other assets are arbitrage to bonds with some sort of spread. So falling interest rates means rising asset prices. So I talk about the idea of endlessly, like a forever bull market where asset prices are chronically and endlessly rising as a process for the conversion. And I use the word conversion, understanding that in common law systems, there's a legal overtone to that word, an illicit taking. There's a conversion of one party's wealth into another party's income, which is pernicious because the party who gets it as income will spend it. Nobody wants to spend their wealth. Nobody wants to be the prodigal son, but this fuels a prodigal economy where one person is giving his wealth to somebody else in the form of profit to the latter, and the person who receives the profit will consume at least some of it. So, for example, my favorite punching bag is Bitcoin, but the same thing applies to real estate. The same thing applies to houses, stocks, you name it. You buy this thing at 1, the price goes up to 2, you sell it. You think you're getting your capital back, but actually you're getting someone else's capital. So you forked over your capital when you bought it to that person. Presumably that was a profit to him, but we're just focused on you. Some new party is giving you his wealth and paying you 2 times whatever number of units. So you take your 1 back and say, okay, that's a return of my capital. You probably don't want to spend that. And then you take maybe another 10% and say, okay, that's the increase in my capital. So you have 1.1, then you have 0.9, that's your profit. And, people spend the income, spend the profit. And so, you go out and buy consumer goods with that. Maybe you go on a bender to Las Vegas, you buy a motorcycle, you buy a BMW, if this was a big enough trade. And you're consuming what was somebody else's wealth. That person would not have bought a BMW or whatever with it. This was to be invested and carefully stewarded. And he thinks he's doing that by buying this asset off of you, but he's enabling you to consume essentially his wealth. Now, supposing the price goes to 4, which is what this guy was hoping for, he then sells it to the next guy who forks over 4 units. So he takes back his original capital of 2, plus, let's say, his 10%, gained his capital. He has 2.2 as capital to reinvest, and 1.8 as his, income, which he then consumes. So he gets to buy something even more expensive than a BMW. Maybe he buys a Bentley, with that. And on and on and on as the asset price is going up, it's generating endless gains. It's somehow squeezing blood out of this turnip. Somewhere this is coming from. And every time the asset price is going up, the next round of traders can trade it and get more free money. It's a free money machine for free consumption. Now, as soon as I say the word free, that should be triggering everybody's radar. Wait a minute. There's no such thing as a free lunch in economics. What the hell is this guy talking about? And the answer is yes, it isn't actually free. This is the consumption of capital. And, there's a variety of other mechanisms, but I'll just highlight those two here to say that this is deadly. And this is not a bug. This is a feature. This is how the central banks try to juice up GDP with monetary policy. This is what they're supposed to be doing, according to mainstream theory. Mm-hmm. And this is exactly how it works. Or when I say works, again, scare quotes, it's not really working. There's something bad going on. But because we use GDP, another anti-concept, another horrible measure, it's not a measure of the economy, it's a measure of something else. GDP goes up when this happens. So how can anybody fault, well, they adjust GDP for inflation, perhaps, but that's missing the point that all of this activity, inflationary or not, all of this activity is bogus activity that is the consumption of capital. Mm-hmm. It shouldn't be occurring at all. And yet, the system is perversely incentivizing it. And if you have a perverse incentive, you have perverse behaviors. If you have perverse behaviors, then you get perverse outcomes. And of course, the perverse outcome that nobody wants is the bust. When the asset price crashes, that's when they think the damage is done. No, the damage was done every step along the way on the way up. And of course, then you have a bust because you find, well, behold, we have a lot less capital than we thought we had. And that's right, because you kept this perpetual motion machine that looked like it was manufacturing capital, when in fact, all it was doing is squeezing the capital out of, the assets.
So Keith, when we hear the phrase capital that is consumed, that's different than deflation by your explanation, right?
Yeah, so I define inflation as the process of counterfeiting of credit. It's a monetary fraud. It's the issuance of debt or currency as a debt instrument. It's the issuance of some sort of debt instrument or credit instrument that is fraudulent in some way, that the borrower doesn't have the means or the intent to repay it, but it's accepted as money good, at least for the time being. Deflation is the inevitable outcome of that, which is the losses that come to the holders of this bad paper in the form of defaults, or in a lot of cases, there isn't a default, there's a cram down. That the debtor comes to the creditors and says, let's work this thing out. And I'm going to trade, for every dollar of debt, I'm going to trade it for 75 cents worth of equity. And you're going to agree because you don't have any better alternatives. Okay, yeah, we agree reluctantly, grudgingly, under duress. That's still basically deflation. And so the more of this that builds up, the greater the deflationary pressures. So, what I'm talking about with capital consumption is something else. I guess it's the thing it's part of how the credit is falsely inflated and then inevitably leading to the deflationary bust that, comes afterwards.
So what do most economists believe is the only source of inflation?
Quantity of money. And by money, they mean either the gold or the paper promised to pay the gold. So they conflate those two things. And they say an increase of either of those things causes prices to increase. And either they define the increase in the quantity of money as the inflation, or they define the increase in the price level as the inflation. But that's the mainstream view. Mm-hmm. Now, the first thing I'd say to those folks is, let me give you three scenarios by which quantity of what we call money could increase. The first is gold mining in a gold standard. The second is issuance of honest credit in a gold standard. That is gold redeemable credit to businesses that honestly are producing the revenues to amortize and repay the debt. And the third is the complete and bogus counterfeiting that goes on with, let's say, quantitative easing nowadays. Do those three different phenomena have the same causes? Well, of course not. And if they don't have the same causes, should we expect them to have the same effects? Of course not.
Effects or
And yet,
outcomes, yeah.
right. So, but we define them all by definition. They're the same thing, which is an increase in quantity, which is inflation, and inflation has one consequence, which is rising price level. And so, economists are just failing to differentiate between three different phenomena here, and they're not really thinking it through. It's kind of at the medieval level. I like to use an analogy of before Galileo, these ivory tower, they weren't really scientists, but they were thought of in the day, thought that, if you throw a rock, it would fly straight until it ran out of force, and then it would drop. And all they had to do was go out into some field and find a farm kid, say, boy, throw a rock. And you could see that it's an arc. But they didn't do that. They just sat there in their ivory tower with their eyes closed, imagining, how it should be, how it ought to be. And, this notion of inflation and increasing quantity is sort of like that. It's not based on any understanding of the real world. It's a presupposition.
So on the other side of that, Keith, we understand inflation. I think most listeners of the show will understand inflation. But what is the definition of stagflation now? And is this a more destructive state for an economy than just pure inflation?
I have to say I find some irony in that term. So before the 1970s should have relegated this whole view to the ash heap of history, economists thought that, I should say court economists, these are the shills for the state essentially, said that there's a trade-off between inflation, so-called, meaning rising consumer prices, and unemployment. That, essentially if you print more money faster, you'll get more employment, but you'll get rising consumer prices. And conversely, if you slow down the printing presses, then you won't get inflation anymore, but you'll get unemployment. So there's alleged to be this trade-off. You can either have low unemployment, but more inflation, or you can have low inflation, but more unemployment. The 1970s came along and slammed everybody in the face with a brick of reality that was massive inflation, so-called, and massive unemployment. I'm just old enough to remember, watching the nightly news with my family in the late 1970s. And they defined it as the misery index, which was the sum of inflation plus unemployment. And they quoted the misery index. It seemed like every day, 5 days a week on the nightly news, they talked about this. And so that should have relegated this Phillips curve, so-called, and this alleged trade-off that should have gone to the ash bin of history of failed economic theories. But it didn't. They coined a term for it, and they said, well, you see, what really happened was stagflation. So it's stagnation, i.e. high unemployment and high rate of rising consumer prices. And there was no curiosity as to what the causes of either of those phenomena were. They just salvaged their busted theory by coining this new term. And so today people use the term stagflation, I think, without really any awareness of the origin of why that term was so necessary to the Keynesians who believed in the Phillips curve at that time. And they use that term today, I guess, to mean roughly the same thing, right, as high unemployment with high inflation. But there's no reason for that trade-off, first of all. And the reason why they sold people on that trade-off is to sell people on the idea of currency debasement and tell them, well, it's actually good for you, see, because we're doing this so you can keep your job. Okay, then I guess I'll have to live with it. I don't want to lose my job, right? And people just sort of gaze their navel and shuffle their feet and, sort of accept it because they've been told, you have to. But, needless to say, in a proper free market, you don't have structural unemployment, and you don't have structural inflation of that sort either.
So Keith, do we need the government to impose a monetary policy? And does this end up interfering and perverting the incentive structure of the currency and therefore the markets that use it as a medium of exchange?
I think you just answered your own question in a nutshell. Yeah, it completely perverts all the signals, and causes, temporarily can boost GDP, which everybody loves, boost consumption. Everybody feels richer. Everybody loves that. At ultimately longer term expense. I think it should be pretty clear. The Soviets tried to centrally plan wheat production, and they had a very fertile area of ground, certainly in the Ukraine and other places that historically always produced a lot of food. And wheat's pretty simple. First of all, the cycle is annual, and all you pretty much have to do is put the same old wheat seeds into the same ground and wait for the sun and the rain to do their thing, and then harvest it. And they tried to centrally plan that, and the net result was mass starvation and millions of people literally dropping dead on the side of the road of malnutrition. They literally couldn't feed people. With the region that had been a breadbasket exporting wheat, for a long time prior to this experiment. Now, credit is not simple like wheat, and even the proponents of this admit there are long leads and lags that can be years or decades. We're taking something with much longer leads and lags, which is much more complicated, not understood nearly as well as wheat, and we're saying, oh yeah, those Soviets, they were stupid to think they could centrally plan food. That's why everybody starved. We're smart. We know enough not to do that. And we're going to centrally plan credit. Now, one of the problems, and there's so many problems you have with this, but one that I like to talk about is when you have a system involving, let's say, the introduction of an error, and then there's a lag, and then you try to correct for that error. The longer the lag, the greater the risk of overcorrection, and then you get into unstable oscillation and a crash. So this is what happens to drunk drivers. I mean, normally you're driving along the road, but your car is never aimed exactly perfect, straight ahead. Of course, the road has curves in it as well, but even if the road were dead straight, like some desert road outside of Phoenix, car's not perfect, and there's play in the steering, all kinds of stuff, right? So every once in a while, you see the road and you correct a little bit. But now when you're drunk, what happens is there's an increased lag, increased latency between when you actually start to veer, let's say, off to the right side into the shoulder, and when you're aware of it, and then an increased lag between when you're aware and when you can make the motor nerves, turn the steering wheel to the left to compensate. And so now you get this resonance between the frequency that the car is kind of oscillating as you're weaving back and forth, and the latency or the lag time of your brain and its control of first of all, its judgment and its control of the motor nerves. And when there's a resonant, when there's a common frequency between the two, when the periods line up, you get greater and greater amplitude until the thing finally, either comes into oncoming traffic or rolls over in the ditch. And that's what happens to drunk drivers, all the time, which is why you shouldn't drive drunk. Well, that's what they're doing to the economy. And ironically and very perversely, so I'm in London at the moment. I don't know if they still have this, but years ago I went to the Bank of England has a museum of money. I think it's on Threadneedle Street, if I remember. And in there, they have a 400-ounce gold bar, and you can reach to the hole and touch it. Okay, fine. What do you do? I've certainly held plenty of 400-ounce bars. I get invited into vaults. But they had an exhibit to try to show you how hard it is to manage monetary policy. And what it was a clear plastic cylindrical tube, I guess about a meter long, maybe slightly less. And there was various graduations, printed on it. And inside was a large polished steel, like ball bearing. And then you had this awkward lever on one end that, you had to try to sort of move, and that would change the tilt of the tube one way or the other. And the gradations on the thing were sort of deflation and inflation, and you're trying to get the ball to stay at the sweet spot in the center. But of course, whatever you would do, you'd tilt it up slightly, and then the ball would and slam into the stop on one end. And then you tilt the tube the other way, the ball would come that way. And, because it was almost frictionless, the slightest tilt to the tube and the ball would hit the stop on the other end. And there was no, I'm watching it for 5 minutes and playing with it for 30 seconds myself and watching a few other people. There was anybody had the skill and to get it in the center. And of course, the sign is explaining this is the difficulty of monetary policy, and it's really hard. And the wizards and magicians and warlocks that are doing this for our society, have to be commended for their exceptional skill or whatever propaganda that the sign was saying. And I'm like, you guys just said the silent part aloud. It's not that complicated, and it's basically impossible. And so they overcorrect, and then they overcorrect, and then they overcorrect, and then they overcorrect, and that's a series of booms and recessions.
Mm-hmm. So Keith, how does this all come back into incentives, and what does a system look like that aligns incentives with, basically how capital should be treated?
So, the root of it is if the government's there picking winners and losers, and I have friends that are, I should say friends maybe in scare quotes. I know a lot of folks in the market monetarist, camp that think the Fed should be a tinkerer, and they absolutely would deny that the Fed is picking winners and losers, because they have a very narrow concept. The Fed isn't picking individual corporations to win and lose the way perhaps a regulator might. But the Fed is absolutely picking winners and losers, and certainly in terms of industries. Mm-hmm. When the government is picking winners, essentially it's doling out free, unearned loot of one form or another. And when it's picking losers, it's basically, giving out beatings and punishments. Obviously, everybody who's aware of this is going to want to line themselves up to be on the winner side to get, a free bowl of dog food, and not on the loser side to get whacked upside the head with a rolled up newspaper. And so, you have people they're basic, as the Fed is doing this back and forth, they're running back and forth to try to position themselves to get the free goodies. And that's, incredibly counterproductive. A free market, it should be emphasized, does not offer a profit to anybody unless they find a way of producing value for their fellow man. This is Say's law properly understood. The only thing you get to consume from the market is equivalent value of what you produce and bring to the market. But those two are equal fundamentally. So to make a profit means you're creating something, and to make a loss means obviously you're destroying something. And in a free market without subsidies and bailouts and all these things, the only incentive is to figure out how to be creative, how to produce, versus how to be a grifter, or how to line yourself up to position yourself for the incentives, that the government is doling out. We're so many decades or century plus from having this in the monetary system, people can't even really picture this anymore. They come to think of the monetary system as itself a source of profits. The idea that every asset is gyrating violently in price is a feature, not a bug. And of course, there are whole industries, from newsletters to brokerages to the clearinghouses to the market makers. It's endless, the number of different industries that profiteer on this state of affairs. And these are large entrenched interests, and obviously plenty of lobbying money and everything else. And the losers are we, the people, that when everything's volatile, everyone's like, okay, how do you protect yourself? And then some people just say, well, I'm going to just suck it up and bear it, and then they put dollars in their savings account and lose value with that. Other people say, I'm going to become speculators. But it's a mug's game, and generally retail isn't going to win speculating on commodity prices. Maybe asset prices generally, in a bull market, everybody betting on houses with leverage is winning. Maybe everybody betting on shares for long periods of time is winning. But ultimately, that's the perverse incentive that's destroying destroying our world ultimately. This is, it's not small.
When we think about incentives, Keith, I touch on this so many times, and I think it's so important to keep in mind when we're looking at all of these systems. So, how are you trying to reward capital by changing the incentives of holding money?
So really interesting question. And it starts with, and I spent years thinking about Keynes has this quote where he talks about there's no surer way to overthrow the capitalist order, which means civilization, than by debauching the money. And most people think he's talking about rising consumer prices, but when you see at the end, he says, and not one is leveraging engaging all the hidden forces of economics in favor of destruction, and not one in a million can recognize what's happening.
Mhm.
And so not one in a million makes me think, no, he wasn't that dumb to think nobody would notice inflation. When I was a kid, again, late 1970, everybody was talking about inflation every day, as they are now. You can't say not one in a million would recognize when consumer prices are skyrocketing.
Mhm.
Not true. They all do. He was talking about rising asset prices and pushing the interest rate to zero, which he knew meant asset prices going to infinity. And what a perverse incentive, right? Everyone can line up and make money by betting. And what Mountain Metals is trying to do, my company, is we say, okay, a good working definition of the gold standard, and silver too is included in this. Silver is absolutely still a monetary metal, notwithstanding rumors to the contrary. That's all being consumed in a deficit. And when anybody can deposit their metal and earn interest on their metal in metal, then that's it's not a formal definition, but I think it's a good working definition. And you get all the other behaviors that you'd expect because you're using metal to finance production. And businesses are borrowing metal to build production, capacity. You get all the other things you'd expect, unit of or medium of exchange, unit of account, store of value, and so forth. I mean, right now, one of the perverse ironies of the whole thing is because the dollar is unstable, but everyone measures everything in dollars, it looks as if gold is unstable. And if you buy gold at a local peak and then it goes down, all the Bitcoiners are like, in case you see gold isn't stable. And it's like, I read about this stuff. They made this perverse that the most conservative savers turn away from gold because they can't accept the price risk. And they turn to what? The open arms of the Treasury, and they buy T-bills. How perverse is that? You're calling it savings, and all you're doing is you're feeding the greedy maw of the welfare state. And the government is going to consume, that's consumption of capital. The government is consume every penny you give them on non-productive things like welfare. But if people can save in metal and earn a yield on their metal and increase their wealth, then that's what it should be, and that's how it was for centuries prior to 1971, when suddenly we're all using irredeemable paper. So there's a simple profit motive to doing it, but then there's the broader. This is how you affect social change. This is how you get gold and silver to actually circulate. It's not a function of price. Back in the time when the price of gold was $200, people would have said, "Oh yeah, if the gold price goes up sufficiently, then gold will spontaneously circulate." Okay, well, what do you mean by sufficient? Well, if it went up to $2,000, I mean, surely by then it'd be circulating. Well, guess what? We got to 2,000, we got to 2,400, no signs of circulation because there's no incentive to circulate it. But if you get paid interest on it, then if nothing else, you can spend the interest. People don't want to spend their principal. Today, gold is principal, it's capital, it's not income. But people will spend the income. And if the income is interest they've earned by financing something productive, then that's how it should be. Mm-hmm. And that's how historically, always was. So that's the counter to Keynes. That's the incentive, not in favor of destruction, but in favor of saving that civilization that Keynes is trying to overthrow.
So how does the yield end up working? Where does the capital come from to pay the yield?
So we're financing, two kinds of businesses right now. We have leases, and then we have loans, which we parcel out as a securities offering that we call a bond. So in the case of a lease, and there will be more products, obviously, as we go and this becomes more accepted. But in the case of a lease, this is for companies that have gold as inventory or work in progress. So this is jewelers, this is platings and coatings companies, this is refiners and recyclers and mints. And they need a lot of gold in the business at all times. And every day they're always buying more raw material. Every day they're selling finished product. But in the pipeline, as it were, there's X amount of gold, which, is usually thousands of ounces. And, if that was copper, I mean, you would just buy it and not worry about it. Copper is $4 a pound, but gold is, $2,300 something an ounce. So that has to be financed somehow. And they lease it from us. So it's not on their balance sheet. It's not available to their creditors. And they don't have the price exposure, which is really the thing that kills these guys. You borrow $1 million to buy $1 million worth of gold. If the price of gold drops 10%, you're bankrupt, essentially, you're insolvent. And they're happy to pay them as a finance transaction for them. They're happy to pay, a lease fee or interest for the privilege of getting, that inventory finance that they need. The other thing that we do, and we have a silver bond right now paying 12%. It's for a silver producer, a mine called Bunker Hill. They produce lead, zinc, and silver, but there's enough silver to cover the loan and amortize it. And so a bond is to finance a loan, to a producer that has metal income. And where do they get the silver to repay it? They literally pull it out of the ground. That's what a mining company does, obviously. And so we're enabling them to go into production. We're being paid out of some portion of that new production, which is exactly how finance should be, right? If the finance is the partner to the entrepreneur and enables the production and gets a piece of it, and the entrepreneur gets a piece. And of course, there's always a negotiation. There's always a little bit of elbowing as to how big that piece is. But, that's what makes the world go around. They're happy to pay because they can make more money. And investors who put up that silver at 12% on your silver, it's better, as we say, better than a sharp stick in the eye. And it's better than, paying for storage of silver, which can be, costly.
So does this not, introduce more counterparty risk, which is something that, we've spoken a lot about on the show, which needs to come into that discussion?
Yeah, absolutely. I mean, number one, there's no such thing as no risk, even if you're holding it in your own hand.
Mm-hmm.
You could be holding it in your own hand and somebody comes along who's bigger than you or faster than you and either beats you over the head or they're just faster than you and they swipe it out of your hand while you stand there. And there's videos of people getting their purses snatched and their cell phones and, tourists and whatever, right? You hide it in your house. Let's say you even have a safe. You could wake up in the middle of the night with a guy with a ski mask sticking a gun in your face. And he says, I know you have gold in the safe. Now open the safe or I'm going to blow your brains out.
Mm-hmm.
So there's no such thing as no risk, even at home. And if you have the metal in a vault or a depository, that's actually lower risk than having at home, but it isn't exactly zero. It's nearly zero, but not exactly zero. And then you're right. If you lend it to a silver mine, there is a risk, and the risk is much greater than, if you bury it in your backyard. That is true. And there's an interest rate to compensate for that. So anybody promising, whether it's gold, silver, or dollars, or euros, or anything else, anybody promising you a return without any risk, run. That person is lying to cheat you out of your money. There is a risk. And then the question is, okay, do you understand the risk? Is that risk, what steps have been taken to try to mitigate that risk? We think that's part of the monetary metals, value add is really studying that, getting to know it deeply. And then, first of all, making sure we have access to the collateral, making sure that we've done other things to mitigate the risk. The mine is at the right stage. A lot of people put money into mining projects at various stages, and the problem is then there's more money coming in afterwards, and you're diluted down, especially on the equity side. As lenders, we want to be absolute last money in. So we're the money that brings them over the top into production, and production is what repays everything and makes it all worthwhile.
Mhm.
So is there risk? There is. So on the silver deal, anybody interested, under NDA, we provide full data room with full disclosure of, what's involved and what the issues are. We went on site, we hired a mining, geology consultancy to look at it as well and come on site. And, all the reports and everything are, made available.
So is this really your guys's concept on trying to bring gold and silver back into the system and actually have it be, used again and in some ways monetized?
Yeah, I mean, we already see customers saying, hey, is there a way I can spend the interest?
Mm.
Which is the logical thing. Obviously, the companies that are financing this way have a decreased reliance on the paper system. They're not hedging. You don't have to hedge the loan anymore. Whereas if you borrow dollars, you have this gigantic price risk, and suddenly there's this hedge need, which creates all kinds of perversities. But so ultimately, yeah, for something to be a proper, let's just say, banking system asset for a minute,
Mhm.
it's got to have a yield. I think it's one of the big blind spots of the Bitcoin guys, and they think Bitcoin would be a great reserve asset. A bank is a spread trader ultimately. You have a giant balance sheet, and then the liabilities are paying X, it costs them X, and the assets are paying Y, and Y is greater than X. So they're making a spread between what they earn versus what they pay. And so assets have to be earning assets. Something that sits there and doesn't earn, but maybe it goes up in price. Well, that's not. Now that's like a leverage hedge fund. It's not a bank, type model. So we're making, gold and silver proper bankable. Right now this is not being done with banks. I really want to emphasize this is us as a, bottom up entrepreneurial company, and we're not a bank. We're not regulated as a bank. We don't ever say the word bank. But ultimately, a proper financial system asset as an asset with a yield on it. Gold's always historically had it. And 1933 and 1971, they broke that. And today everyone grows up thinking, of course, gold is a dry asset, right? That's Warren Buffett's complaint. It's not productive, it's not procreative, it doesn't earn anything. It's a joke. And he's right in the sense that without a yield, most mainstream finance people will regard it as a joke. But with the yield, it becomes a serious financial system asset, which is the whole point. And yes, that's our secret mad plan to reintroduce gold, and gold will take over the world. Yes.
Well, come on, Keith. There was a yield on crypto. I believe it was called Celsius, and we all remember how that ended up.
Yeah, I was going to say that there's various I call them self-referential, schemes that entirely within the system, somehow it's supposed to circulate and generate a yield or whatever, and it blew up, and I think there were criminal charges filed in that case, weren't there? Something wasn't quite as it was promised.
Weird. Well, Keith, I think that's a good place to kind of wrap up for today. I appreciate you always explaining these complicated and interesting topics to us. Is there anything that you'd like to leave our listeners with before we wrap up?
Yeah, Silver Bond is open at the moment, so anybody interested should come to monetary-metals.com. We're paying 12%. It's open to accredited investors only, which basically means $1 million net worth, not including your house, or $200,000 income if you're single, or $300,000 if you're married.
Mm-hmm. And of course, you're a great Twitter follow as well, at Real Keith Weiner. Keith, thanks so much for your time today. Really appreciate it.
Good to be here. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.